Good evening and welcome to the Fiscal and Economic Issues Discussion Group. This is our October meeting, part of the Northwest Suburbs Organizing for Action and individual groups. And we go through a series of economic slides. This is an open discussion, meaning as you want to ask questions or make comments during the presentation, you can. You don't have to wait till the end. You can certainly speak up through the system, or you can raise your hand through the software, and someone will eventually get to your question. We'll answer it. So it's informal. We go back and forth. And then if you have a rant that you'd like to share, you wait until after we end the presentation, and then we declare that it's open pizza time, at which stage, by all means, all things can be discussed at that point. But we're trying to keep it to the economics for a while, and all questions and comments related to this material is our fair game. Our mission here is to help you understand the facts. We give you the most credible sources. So that's from usually the government agencies such as the Bureau of Economic Analysis, the Congressional Budget Office, Bureau of Labor Statistics, and then in some cases we'll use major media as well, you know, the New York Times, The Economist, and others to share this. Carl and I are familiar with different government sources of information. We use the Federal Reserve data, the Federal Reserve Economic Database to help you get the facts. And you can take those arguments to your social media, to your friends, people that aren't your friends, to whomever you wish to sharpen your arguments and communicate to your audience. And generally, this video is shared on YouTube of the presentation, and you can always refer to them there and share them widely. We encourage you to share the slides that are included in this presentation through Twitter and other forms of media. And Carl, do you want to start with some of the labor market stuff, and I'll pick up thereafter?
We've had, as we see here, a big drop in jobs March and April last year, a fairly quick recovery of about half of those jobs, and then that's flattened out. We actually lost jobs in December, and we've been adding jobs under President Biden. So I think it's been 4.8 million jobs that have been added in the last 8 months. And it was jobs were up 194,000 versus August, not July, but oops. But private sector jobs were up over 300,000 because we lost over, on a seasonally adjusted basis, we lost over 100,000 government jobs. And the analysts I've seen who've looked at that suspect that has to do with school jobs, that the schools have not hired as many people this year as they normally would. And so that's what caused the seasonally adjusted job loss of government jobs. If you're in the Chicago area, you've seen all the ads and other stories about not being able to find school bus drivers, substitute teachers, and that seems to be a national problem as well. And so a lot of those positions are just not getting filled. Okay. Again, this is speed at which, jobs are regained. The big thing here in the comments section is that the 194,000 was short of expectations, but if you figure it as 300,000 private sector jobs, and we went ahead and adjusted the prior months by over 100,000 private sector jobs, the total number of jobs actually went up fairly well. Okay, next. Unless you wanted to add something on that one. The employment numbers are, again, there's two surveys. Jobs come from the establishment survey companies. Employment numbers come from the household surveys, are you employed? So jobs are payroll jobs. So the difference is that 1099 jobs, gig jobs, Uber and Lyft jobs are in the employment household survey employment numbers, but they're not in the establishment survey. So if we look at the last couple of months, we see that the employment numbers went up by over 500,000 each of the last 2 months, even though the jobs numbers were lower than that and disappointing. So what does that mean? That as people were getting kicked off of unemployment, insurance, if they were prior gig workers, they went ahead and got gig jobs again, maybe DoorDash, Uber, Lyft, demand is up and they're getting more workers for those kinds of jobs. That's one explanation. I'm not sure what the other ones might be. But again, if an Uber, a Lyft, a DoorDash driver is in the employment numbers, but not in the payroll jobs numbers because they're not on the payroll. Next.
I think it's interesting that in the last year, the two numbers are exactly the same, which is not necessarily required. It just happened that during this period, the September to September period, they're the same.
Yeah.
Surprisingly.
Over long periods of time, they tend to even out and move in sync. You want to talk about childcare employment?
Sure. Let me just start up my video here. Here we go. I'm learning these tricks. So strangely enough, you hear about why aren't people returning to the workforce? Why do we have 10 million open jobs? And one of the interesting anecdotes here is that childcare employment is still 10% below where it was before the pandemic. And that's an indication that either people don't want to do those jobs anymore, or parents are not allowing their kids to go back to schools. And so you're seeing that the employment is about 10% below where it was before. And the question is, how do you get that employment back to par? How do you get it back to the peak again? And so there isn't a particular plan in place to do that, but other than vaccinate everybody, get the virus under control so that people are willing to send their kids back to school, and we can get those schools to start hiring back to at least where they were before the crisis hit.
Okay. Unemployment rates continue on a downward trend. Again, the U3 is the widely reported unemployment rate, and it dropped from 5.2 to 4.8%. A little bit of that was due to a shrinkage in the number of people in the labor force, but the big piece of that was the 500,000 more people were employed. So that was a good number. The U6 unemployment rate dropped also from 8.8% to 8.5%. Again, the U6, as we've talked about at prior meetings, is everybody who's unemployed in the U3 rate, which are people who had searched for work in the prior 4 weeks and were not working. The U6, it counts everybody who looked for work in the prior year, and it also includes people who are working part-time who want full-time jobs. Now, of the 27 million or however many people who are working part-time jobs, most of them want to work part-time, but there's a substantial number, around 5 million or so, if I recall correctly, that are people who are working part-time who would like to be working full-time. And so those are the two areas that bump up the U6 rate above the U3 rate: the people working part-time who want full-time jobs, and the people who didn't look for a job, didn't look for a job in the last month, but looked for a job in the last year.
That's a pretty big drop in the unemployment rate, the U3, both of them actually, but to drop 0.4 is a pretty solid number for 1 month.
Yeah. Again, it was solid growth in employment and I think about 200,000 fewer people in the labor force. I'm not sure what caused people to drop out of the labor force. Employment to population ratio for prime working age people, 25 to 54, which for the most part is people who are past student age and before retirement age. with people going to grad school. That may not be totally accurate, but it's what we use. Excuse me, hiccuping a little. And so we still have fewer people working than before the great, the great downturn of the COVID, but it's coming up. It's moving in the right direction. And we'll see how that goes. I'm looking to see pretty good recovery by next year on jobs, employment, and these employment to population ratios, but we'll see.
The unemployment level,
yeah.
Sure. You've got an unusual kind of thing here where the job openings are unusually high. So you figure they're normally, if you go back historically, they're more like 6 million normally, and now they're here in this 10 million plus range. The hiring is at about the typical level. It's at that 6 million or so range where it normally is. It's not that elevated, not that different from what we historically see. And the number of unemployed people, the blue line, had peaked with the crisis and now is coming back down. It's not quite down to where the 6 million number we had before the crisis, but it's getting there, still in the high sevens. And, so we've got a ways to go to improve the unemployment rate, get back to that very low unemployment rate we had back in January of 2020. But the story here is a giant number of job openings, but just not hiring anywhere near that speed. And there's a lot of different views about why that's happening, that gap between the red and the green line being the one that's unusually high. And are employers more demanding? Are people just not interested in the jobs that are open at the pay rate that they're being offered? Are people staying on the sidelines and not really making themselves available? So the openings are there and the hiring is just not jumping because more people are just not getting out there. It's very difficult to kind of analyze this information and understand exactly why that gap is there. It's notable that there are a lot more openings. You can bridge that in a variety of ways. You can pay people more. You can corporations can make it a little bit easier in some cases, but to lower their standards in some areas that they're hiring. You can bring in more immigrants. There are a variety of ways to go at this, but right now there isn't, as far as I can tell, a particular policy, again, other than addressing the coronavirus, addressing it with vaccination to really close that gap. Specifically, if we get the $3.5 trillion plan or the $1 trillion infrastructure plan in, that should help at least with hopefully encouraging people to take jobs. But at the same time, you're going to see job openings probably go up even more because you're going to be demanding a lot more stuff, things to be done. So it's going to be interesting to see how that red and green line close. All right, Carl, back to you with, you've got all these numbers memorized.
Got a confusing chart with 20 numbers up there, so yes. Well, it just shows what's happened with the numbers and what's driving the numbers on the household survey. The population grew somewhat between August and September. It doesn't have much of a seasonal effect. This is what I'm talking about. The labor force actually declined by a little under 200,000. Who those people were, I'm not sure. It's possible that people who are coming into job requirements that require them to be vaccinated, people are deciding they don't want to be vaccinated, so they're dropping out of the labor force. That's the only thing I can think that would cause that to
interesting. Okay, yeah, sure.
In that direction. But again, a 1 month number could just be a data anomaly, and it'll reverse itself next month. And so I don't get too concerned about it until I see a trend. The number of people employed, we talked about, grew by over 500,000. And so it's the combination of a good jump in the number of people employed and a slight reduction in the size of the labor force caused the unemployment rate to drop by 0.4%. And then the number of people working part-time for economic reasons stayed pretty constant between the 2 months. I think when I was going off the top of my head, I said it was about 5 million, and it's actually about 4.5 million. So it's down.
And you have the math here for any of these computations. So if you forget where these ratios and formulas come from. All the data you need is right here, and the algebra is explained over there on the left-hand side. So you have this as sort of a reference if you're trying to interpret these numbers.
This is a note that comes into the employment situation summary. In September, it said 5 million people reported they were unable to work because their employer closed or lost business due to the pandemic. That is, they didn't work at all, or they worked fewer hours at some point in the last 4 weeks due to the pandemic. That 5 million is down from 5.6 million in August. So that's, again, moving in the right direction among those who reported in September they were unable to work because of pandemic-related closures. About 15% or 1/6 of them received at least some pay from their employer for the hours not worked, little change from the prior month. And there were people who were prevented from working because of the pandemic. Budget deficits, and this is where we get interesting numbers, and Bill wrote his headlines for tonight's meeting. But the red bars are Republican fiscal years, the blue bars are Democratic fiscal years, and the gray bars are whoever gets elected in 2024. Because, again, fiscal years run from October 1st to September 30th. So President Biden got elected in 2020, took office in January of 2021, but this 2021 fiscal year just ended on September 30th. It ran from October 1st of 2020 to September 30th of 2021. So it began under President Trump, and about the first third of the year, fiscal year, was under President Trump. And so this is Trump's budget year, and 2022, the fiscal year that just began, is Biden's fiscal year, first fiscal year. The $3 trillion estimate for the budget deficit for fiscal year 2021 is from the July CBO report. The 2.8 trillion is from CBO estimates that have come out this month, but we don't have the official Treasury report yet, but I suspect that the actual budget deficit will come in at right around that $2.8 trillion number. So it's a little bit better than the $3 trillion forecast that we had in July. Things improved by 200 billion, which is a good number. Now those numbers that we're just looking at include the American Rescue Plan, but they do not include the infrastructure plan, the $1 trillion infrastructure plan, and the family plan and the reconciliation, which has been tossed around at a $3.5 trillion number. What I'm reading today is it's more likely to pass at a $2 trillion number, but who knows? And then as you go to the out years, the increasing budget deficit is the population is aging. We have more people who are being supported in Medicare, Medicaid, and Social Security. And that's what's driving the budget deficit in the out years there. But it looks like we're going to go from a $2.8 trillion deficit the last fiscal year to a $1.2 trillion deficit the current fiscal year, and then be under $1 trillion for the next couple of years.
And when you hear people, yeah, that's good. When you hear people putting pressure on the Federal Reserve to take action and deal with inflation, just keep in mind how this red line is going to drop to this blue line. I mean, the infrastructure bill, because we were already spending about $80 billion a year on infrastructure, CBO, the way they did their math, they're figuring they're going to add, that bill will only add about $250 billion or so to the deficit that they've already projected. So that's basically a rounding error. You're barely going to notice the infrastructure trillion because it's not really a trillion, it's really 250 billion as far as this forecast is concerned. Depending on the 3.5 trillion and whether it passes at 2, passes at 3.5 on the spending side, Biden keeps saying we're going to have tax increases in there to pay for some or all of it. He wants to pay for all of it, but we'll see about that. But even if it's, let's say it's $1 trillion net, you know, 2 trillion, as Carl said, spending maybe $1 trillion in tax increases, $1 trillion over 10 years, again, is barely going to show up. It's barely going to move the needle on these numbers. So the deficits are going to come down dramatically. So if the concern is inflation, Fed needs to raise interest rates, yada, yada, these budget deficits are going to, the federal government is taking its foot off the gas pedal, so to speak, from going from 3 trillion down to $1 trillion-ish over the next few years. It's a fiscal cliff. Nobody's calling it the fiscal cliff. Remember how that was a big deal back in, was it 2012 or 13, Carl, was the big fiscal cliff debate? Was it then? But this is a giant fiscal cliff. Nobody's really talking about it as such, but it's big.
So it'll be interesting to see how the economy, deals with this fiscal cliff and the additional spending in the infrastructure bill and the reconciliation bill may help avoid this being too bad of a fiscal cliff. Because the money, even if the reconciliation bill is fully paid for, it's transferring money from people who don't spend it to people who do. On the spending side, I'm sure everyone has been reading lots of articles about how the Democrats have this big spending bill. If the $3.5 trillion gets, added, again, that's $350 billion a year. If we look at the numbers for fiscal year 2021 outlays or spending total, it was $6.845 trillion. The projection without the reconciliation bill for Biden's first fiscal year 2022, is $5.544 trillion. So we were looking at about a $1.3 trillion drop in spending. And if the reconciliation bill passes at the full $3.5 trillion, that's $350 billion. It's still going to be almost, a little short of $1 trillion cut in spending in Biden's first fiscal year. And all of the Biden years look like they will have spending below Trump's last 2 fiscal years. This is something I hope we can get the Democratic leadership to start talking about. And we don't end up repeating the 2010 midterms where the Tea Party came in saying that we need to have real cuts in government spending, and nobody bothered to point out that a month before the election, fiscal year 2010 ended with the first real cuts in government spending and nominal government spending, not inflation adjusted spending, since fiscal year 65. It just got ignored. But anyhow, the debt ceiling issue got punted down to early December. The end of the fiscal year appropriations has a continuing resolution to the beginning of December. So we have a little bit of room to resolve those issues. The big, but again, those are less than 2 months away. And we've got the Thanksgiving holiday in the middle there. The big problem is the debt ceiling. If we can manage to do it as part of the reconciliation bill, the Democrats can do it on their own. If we can't manage to do it as part of a reconciliation bill, we've got a problem, because McConnell has said the Republicans will not help us again to get to a vote. And apparently they're saying, if you can't do it on your own, we'll vote against doing a reconciliation bill, and we'll let the economy crash, because we don't want the economy to look good on Biden's watch anyhow, or something. Not sure what they're thinking is.
Party before country.
Yeah. Okay. For some reason, we're using seasonally adjusted, because normally the reporting is the non-seasonally adjusted, but we'll go with these. The non-seasonally adjusted numbers have the last 3 months on the core inflation, the red bars, of 0.3%, 0.1%, 0.1%. They're a little higher here, but they're still, average 0.2%, which would be 2.4% inflation over a year, which, if that's where we're at next year, with the 12-month inflation being under 3%, I don't think anybody's going to, get too terribly upset about that kind of inflation. And that's the core inflation numbers are one of the reasons why I'm not overly concerned about, the inflation numbers. We obviously, used cars tend to still be priced way up, although actually, as we'll see in a slide or two, the price of used cars has actually gone down the last couple of months. But again, the inflation numbers right now, we're not seeing the kind of 0.8, 0.9% growth that we saw over the summer, late spring, early summer.
So Carl, what you were saying with the red bar is that if we took the last 3 months, they average about 0.2, and if you multiply that times 12, that's about a 2.4, 2.5% inflation rate with a little compounding. Not something to be particularly concerned about. Not like the 0.9 times 12 would.
Yeah.
Okay.
And again, I'm more concerned about the core inflation because the food and energy prices tend to be volatile, and I don't think they're going to stay up. We'll figure out what's happening with gas prices, and by a year from now, 2 years from now, those supply chains will be worked out. So we see here on the 12-month inflation numbers, core inflation is currently down to 4%, has been for the last 2 months for the 12-month numbers. But again, we're still measuring against some numbers a year ago. The 12-month for September on core inflation was 4%, and 5.4 on the overall. I think the year before that, we were at 1.4% for the 12-month in September of 2020. Yeah, you can see that on the far left side of the bar of the graph. So, if you look at the 2-year rate of inflation, I think it works out to something like the overall inflation over 2 years is running at about 3.4%, and the core inflation is running at about 2.9%. A little higher than the Fed would like, but not yet something that's causing anybody to get too excited. And this is where we're talking about the components of the inflation number, where food on 12 months is running actually a little lower than the all item. The big numbers are in energy, where gas prices are 42% higher. Fuel oil is 42% higher. Overall energy is 25% higher. And gas service is 20% higher, so that's interesting. And then we see the big jumps in the core inflation, not including food or energy, are those used cars and trucks, which are up 24%, but have gone down in the last 2 months. So we'll see what happens with some of those numbers.
Yeah, I mean, one of the things the Fed is watching for is investors changing their expectations or consumers changing their expectations about inflation, meaning if people are worried that prices are going to go up, they tend to buy stuff now, which causes those prices to go up even more, and you get into this circular situation. And if investors begin to think that that inflation is going to be higher in the future, they will demand higher interest rates on bonds to compensate for that, which could also slow the economy because interest rates, people don't borrow as much when interest rates are higher. They don't take on mortgages. They don't borrow for business purposes. And so here what you see is the 10-year Treasury, that's the red line, and then you see the inflation-protected 10-year Treasury line, the blue line, which are called the TIPS, Treasury and Inflation-Protected Securities, or TIPS. And the difference is the 2.5%. So if you say to an investor, I'll protect you from inflation, they're saying, I'll take a negative return, believe it or not. They're saying, I'm okay with giving you 1% a year because I'm so afraid of either much higher inflation or that something bad would happen. There's some fear out there, but generally this gap then to a 1.5% for the Treasury says that investors expect inflation to be about 2.5%. They expect it to be that difference. They want, if they want 1.5% for a non-Treasury protected bond versus a Treasury inflation protected bond, that's what you can see it right here, 2.5. And in the past, it hasn't been this big a gap. I mean, you see it in a couple of places where you have pretty good sized gaps, but you have places where it gets really narrow. Like here, when inflation got almost zero, when the crisis hit and prices were falling like crazy, the spread became almost nothing. The difference between these red and blue lines became nothing, meaning investors for a little while were expecting inflation to be zero over the next decade. And I say over the next decade because these are 10-year bonds. If these were 30-year bonds, I'd be saying over the next 30 years. But this is just for 10 years. And it's interesting to see what investors, how they behave. So when you hear people talking about what are investors thinking, it's because they analyze things kind of like this, of looking at two different similar securities, but with one key difference in that the blue line is protected from inflation, the blue security, and the red one is not. And if this gets really high, if this goes to 3, 4, 5, 6%, that's going to be something that the Fed gets a little more nervous about than they are now. And, that's what they're keeping an eye on this, along with, you see the headlines with all these numbers. But this is the one I think that the Fed is probably as concerned about or more concerned about internally. The good news is wages have kept up with inflation, meaning that compared to the beginning of the crisis, real wages per hour, this is the hourly earnings of production and non-supervisory employees in the private sector. And this excludes some of the higher earning management people. So when you include management in there, meaning you make, where they say the average hourly earnings of all employees, that includes some higher paid people. This gives you a better sense of the middle class or the workers and not the managers. How are they doing? Well, the real wages are actually higher. And so this blue line, the nominal wage increase, has been keeping up with inflation. And you can see here where for the past year or so, since July 2020, this has kind of moved sideways, sort of moved in a range. So essentially, no matter how much you hear about inflation, wages are also going up and keeping up with that, which is a good thing.
If you look at the graph, you see that what happened is a lot of lower income people got laid off during the recession a year and a half ago. The blue line probably is the one to look at. And then as people started hiring those lower wage people back, that came, the average wage came down, because if you had people that were making $40 an hour and somebody making, well, let's do the simpler math, the 30 and the 20, if the $20 an hour person lost his job, the average goes to 30. When the $20 an hour person gets their job back, now we're back to a $25 average, but with earnings going up, that 25 is now 26. It's just more than two people in these numbers.
And this tells us that purchasing power is keeping up. So as much as you hear people complaining about inflation, bear in mind that the wages are going along with it, and people are increasing their purchasing power, or have stronger purchasing power than they did before the crisis hit in January of 2020.
Yeah.
And in general, this graph only goes back to January of 2017, but this trend doesn't always happen of real wages going up nicely. This is something that happens toward the end of a boom, or as you get into a boom where the labor market tightens and workers have a little more bargaining power. It's when the economy is weaker that you don't see this. When the economy is weaker, you don't see the real wages going up because these nominal wages are not moving up the way they are here. But this is a pretty steep incline in the nominal wages recently, which is why this red line has been keeping up with inflation.
Yep.
Another interesting thing about this crisis is it's not everything is uniform, meaning there's the goods. If you think of the economy as goods and services, you split out those sectors, services are still below where we were pre-crisis. If you think of the 100 as the starting point, these are all percentages down or up from there. And so like 105 means you're 5% above where you started. 110 means you're 10% above where you started. The goods component of GDP is almost 10%, 9% plus above where we were before the crisis, but services is about 3% below. And you can imagine that people aren't going to barbers, they're not going to restaurants, they're not as much, they're not getting their nails done, they're not doing a lot of different kinds of services. And so overall, the economy is about 0.9% larger, and this is real. This is means adjusted for inflation. So the economy is bigger than the level size of the economy is the largest it's ever been, but it's not that high above the pre-crisis. It's only about 1% above the pre-crisis level because services are dragging down. And the services part, I don't have the exact numbers. Maybe Carl, you might know, but services are a larger part of GDP than goods. So
we're going to get the third quarter GDP numbers will be reported, I guess, next week, end of next week.
Yeah. It'll be interesting to see if the services are catching up and if that goods line starts to flatten out. But you're probably hearing some news, and we've got some slides here to talk about it. You know, the ports are really backed up right now. And people are thinking that's part of why we're seeing inflation, particularly in the goods, because as I showed you just a minute ago, the demand for goods is very high. The goods part of GDP is 9% above where it was before the crisis hit, which is a big increase. And so Jason Furman, who was he was the the chair of the Council of Economic Advisors for the president under President Obama. He's a Harvard economist. He tweeted this out, talking about port volume, showing that these are huge spikes over where port volume normally would be. He said normally volume's up about 4% a year. These were annualized rates going into the 50 range, 40-something range. It's mellowed out a little bit, but still plus 20% January to August, and versus 4 historically. This is a more normal kind of bar where it is, and these are the abnormal kinds. So that's part of why you heard Biden recently, I think he was starting to talk about how do we get our ports to operate 24/7. I suspect in some cases they were already, but at least he's been pushing them to try to move these goods through it. And there was an article today, and I think it was in the Washington Post, it could have been the Times, where they didn't read through it, but they talked about how there's a record backlog in one of our major LA ports, the largest port. So there's all these goods that people want, and they're backed up. So Biden's been having a tough a couple of months. You probably heard his ratings have been going down. And one of the things that we try to do as part of this group is give you tools you can use to market the stuff that Biden has done. And so you've got, on the left-hand side, you've got the American Rescue Plan, which passed back when Biden first started. I think, was it March?
Yeah, it was in March.
It was March. So you got the $1,400 checks. You still have the $300 to $350 check per child coming every month for a year. I think it continues at $300 to $350 per month until December, and then when you file your tax returns, I think you get the rest. Correct me on that if I'm wrong, but I
believe
that's
correct, yes.
You've got ACA subsidy eligibility was expanded by about 3 million people. I think they lifted the percent of poverty that was eligible for those subsidies. You've got zero premium health insurance or close to it if you were getting unemployment insurance. Free COBRA for 6 months if you got laid off, or free meaning government covered the cost of it. All of that passed without Republican support. We're out of Afghanistan. As much as people can complain about how ugly it was, we're out of there after 20 years. And the COVID vaccinations started, and for good reason. I mean, they were 4% because we had just started the vaccination program, but significant progress from 4% to 64%. Approximately where we were as of a week ago, and that's partial or fully vaccinated. When you look at some of the statistics that Carl and I have covered here, Biden has had job growth of 600,000 a month. Yes, that's part of the recovery, but good, robust job growth is 200,000 a month. That's solid job creation, and so he's averaging 600,000. Although the last couple of months have been more like the 200,000-ish range. And that's kind of where we were before the crisis. Trump was at about 187,000 a month, even before, before the crisis hit. Those numbers do not include the big decline in employment he had. Those are before he was doing about 187,000. You guys have seen charts that we show where we would compare that against Obama, where he was 220-ish, I think, Carl. In Obama's last 3 years versus Trump's first 3 years, Obama created more jobs created under Obama, and it was significant, about a 20% difference more in the last 3 years of Obama versus Trump. So Biden's doing fine. There's a chart I shared with you guys last month or 2 months ago that showed I think it was last month, the percent increase in employment since a president took office, kind of comparing the different presidents. Biden is more or less tied with Carter for the most percent increase in jobs, the level of jobs in his first, time in office. So he's on a very strong pace right now. Granted, it's a recovery. He's not in record territory already and then going up beyond that. But still, statistics, you can a little bit, I wouldn't say it lying with statistics, but the number is what it is. I mean, if we're doing marketing, that's what's happening. The unemployment rate has fallen quite a bit under Biden, and it did just this month too. 0.4 is quite a big drop. The stock market is up almost 20% after today. So it's that part of the economy is doing well, and the real GDP level is about 3% higher than it was in the fourth quarter of 2020. You could certainly argue, and I think Carl would, that Q1 of 2021 is Trump's last quarter. We're just a little bit above that point. But still, the economy is as big as it's ever been right now. So, people complaining about inflation or this or that, they're just, mostly things are going well. You have a large number of people that we need to get back to work. That's our real challenge. It isn't that inflation's a big out of control problem or that the economy is in the tank or that things are going badly. The stock market wouldn't be doing what it's doing, and the GDP levels at an all-time record high level. We're okay, and you can keep marketing this. I just started sharing this slide the other day on Twitter, and you're welcome to steal it and put it out there, and we'll update this or something like it. We'll probably create the right-hand side of this as a graph at some point. It's a little bit easier to digest than a bunch of text on a page, but don't feel intimidated by what Republicans are saying. They're getting a ton of airtime. We got a good economic story to tell.
Definitely. And I mean, let's talk about the stuff on the right on this graphic are things that are occurring on Biden's watch. The things on the left side are clearly things that he actively accomplished with the American Rescue Plan Act, getting out of Afghanistan, getting the people vaccinated. One thing that would be interesting to see is a lot of companies now are requiring vaccinations. A lot of people are requiring vaccinations to attend certain events. I think the US Open tennis tournament and the most recent one in Indian Wells last week required people to be vaccinated. And so I think that people are finding that if they want to live their life the way they used to and do the things they used to want to do, they're going to need to be vaccinated. It'll be interesting to see if we require vaccinations for domestic air travel this year, because if we do that, I think that's going to capture a lot, more people that are going to want to go ahead and get vaccinated, so they can travel, so they can take, the airplanes. So I think that things are going to go better. They're going to go well, barring, some terrible variant of the coronavirus that shows up that we don't know anything about yet.
And this is just a series of articles and links that you can share. One of the themes that's in here is that the economy does far, far better under Democratic presidents. And there are a couple of articles in there. And last month, we shared a presentation on that. You can certainly see the video, or if you missed last month, I think we distributed that to everybody on the list. So if you're new to the list, let us know and we'll get you on there. We'll get you that presentation. But there's a bunch of good slides in there to share. The economy does much, much better under Democrats on any measure you can come up with, and the deficits tend to be lower. And despite that, when you see polling on who's better at handling the economy, Democrats or Republicans, Republicans tend to poll better. And we've got the facts on our side, and we need to battle that out and make it clear to people that you want a good economy, you hire Democrats. We always say, 10 of the last 11 recessions started under Republican presidents. Hire the lucky team. if it isn't for a particular reason, at least hire the team that manages to avoid these recessions. The Democrats tend to be the cleanup committee, unfortunately. And 10 out of 11 is I haven't got the statistics with me, but if you're going to flip a coin 10 out of 11 times, getting heads, that's an incredibly rare event. So I can't imagine that 10 out of the last 11 recessions starting under Republicans is a coincidence. This is a shorter presentation than normal. Usually we have like a lengthy set of special topics that we go into. We're not doing that this time, just the time permitted that we had. So we're actually pausing here. We can take questions, comments, and then open it up for what we normally would do in the past was we would go out for pizza and then chit chat about anything that comes to mind. And so once we close after we answer some questions about this presentation or other economic things, we can officially close and then go to the chatting. So any questions, comments for Carl and me? Nabila, I see you've got your hand up.
All right, I will keep that in mind. Hi, everyone. Thank you so much. That was a very insightful presentation. I definitely learned a lot. I was wondering, you talked about childcare employment and it being extremely low right now. And I know you mentioned it's a possibility that parents aren't letting their kids return to school, which may result in lower employment. Do you think there's any possibility that because childcare employees are being severely underpaid, as we're seeing in a lot of different industries, that's a reason why you're not seeing as many folks
I think so. Yeah. Oh yeah, I definitely think so. And there's this, it's really hard to get good data on this. There isn't I would say one source that's been able to sort of pull all that together. But if you think of people that were in restaurants that moved over into warehouses, let's say they work for Amazon now, they used to work in restaurants. I think you're seeing some people probably from childcare that moved out of that space just because it's a difficult job, but also they're seeing pay go up quite a bit in those other industries, and maybe theirs is behind. I don't have data on whether childcare services wages have stayed the same or gone up. I would guess by looking at this that they haven't moved as much as the competition, because not everybody's this far behind where they were before the crisis hit. I'll pause there. Carl, any?
Well, I guess I'd say two things. Number one, if I owned a childcare business, I've got two pressures. One, my employees want to make more money than they did before because they're working in an environment with kids that have not been vaccinated, and so it's a health concern. It's a greater risk to work in that environment. And you also have, as you want to raise your prices to pay your employees more, so far parents have not necessarily received a lot more from the government to help people pay for childcare. And so I think that that's what's happening a lot for those. I mean, you do have the parents that are reluctant to put their kids in childcare with a bunch of other kids that aren't vaccinated. It'll be interesting to see how that changes over the next few months, especially with 5 to 11-year-olds being approved for the vaccine probably within the next month.
There's a question here. What is your view on energy? Demand seems to be up, but some companies are disinclined to increase supply. Are they just reaping profits by restricting supply? Good question. One thing that we've talked about, I'll use gasoline as an example. You can see here that the price is up 42% versus last year. But when you compare it, and it's around $3, it's a little bit over $3, $3.10, $3.15, something like that. When you go back and compare that to where we were in 2019, gas prices typically in the summer get to around $3 a gallon. So gas prices aren't very much different from 2019 and 2018 levels. And even going back before that, gas prices were higher. So what you have is a weird scenario where gas prices cratered in 2020, and then they spiked back up. Let's say, I'm using round numbers, but let's say they went from $3 to $1.70, and now they're back to $3. That's where the 42% is coming from, but it's really not all that different over 2 years. Gas prices aren't all that different going back. So I'm not sure that there's a supply crunch or any other. It seems like we're just getting back to more normal usage. I have not heard of companies playing with the supply, but I'm not current on OPEC, Carl, and or if there's an OPEC angle to this, that they're restricting oil prices, but gas prices are not crazy high compared to where they normally are, this time of year.
Okay, somebody said Bill had his hand up. Did you have a question, Bill? Comment, something?
Actually going back a while, when you were talking about the jobs for this last month, I think there was also a note that they had revised the previous month up by a significant amount, like 170,000 jobs or something like that. If you could explain to me once again why that happened. I know there's two different.
Okay, the jobs numbers come from certain reporting by businesses about how many employees they have, and businesses don't always respond on a timely basis. So that what you have is you'll get a number for a particular month, like the 194,000 that gets reported, and then as additional data comes in over the next couple of months, that number will get revised up or down based upon that additional data. And then, just to make life interesting, sometime next in the following year, when they get all of the unemployment tax returns, because businesses that have payroll have to pay unemployment insurance premiums for each of their employees, that's when they get the final accurate count, or most accurate count, of how many employees there are, how many payroll jobs there were. And so you end up seeing further revisions that occur months and months later, but you'll get an initial number that's usually fairly accurate, and then for the next 2 months, a couple of months of revisions, and then a year later, more revisions.
Okay, thank you.
You'll see it
the tax filings.
You'll see that some things with like GDP, for example, will get revised up and down. And it seemed like with Trump, several times the GDP got revised down. Like you saw some quarters with a 4% increase, annualized increase in GDP, that were later revised down, to around 3 something. And you can see some pretty significant swings as they get more data in these different numbers. So it helps to kind of look back a month to kind of do that. Now, when you see a slide like this, or you see a slide like this, those have been factored in, meaning this is what the graph looked like as of the September reporting. And so if there were adjustments to the jobs, the number of people that had jobs, that's in here. But just so you know, that this reflects the latest data that we have for every period going back. If for example, let's say the August number was a little bit lower, then last month, if we had this graph superimposed here, it might have been a little bit lower than this. But when you go to the Federal Reserve economic data, you see it at a point in time with the revisions. You may not easily be able to go back and look at what it was previously reported unless you look at the releases. You have to look at the actual release itself. And Carl may know maybe on the BLS site if they've got some history there, but I haven't seen it that way. You usually have to look at releases to kind of figure out what did they report as of that point in time, because those numbers get overwritten in the database that is used to generate, say, this graph.
I learned that when I was first going back and looking at what was happening when President Obama took office in 2009, and I memorized how many jobs were lost each month in those first couple of months. And then they kept changing, kept getting revised. And then they did a 5-year revision because they did additional seasonality adjustments.
Yep.
And don't fall in love with a particular number that got reported because it's going to change.
And that's part of why having when you do like a rolling, I don't think we have any of those in here, but sometimes we'll do like a rolling 3-month average or a rolling 6-month average to see, it smooths out some of those monthly fluctuations. And so you can get at a pretty good trend. We were doing that during the latter half of the Trump administration, where we were showing the 3-month or the 6-month rolling average of the job creation numbers. That 194, we were presenting that as a 6-month rolling average. So we had the current period and the prior 5 periods averaged. Each point was the average of 6 points. And that smooths out these lines nicely when you're looking at those. All right, I'm just looking at some of the questions that came through the chat. And if anybody else has a question, by all means, speak up. I'm just looking here.
Do we want to have further discussion of a recorded video, or do we want to go off the video and just have further discussion over beers and whatever people have for snacks at home?
I always say, Carl, I miss the Oreos badly. Those are contraband in my home. And so when I would escape and go to the thing in person and get them, I would, that was one of my favorite incentives, to go visit you guys in person. Yeah, let's close down the official part of it. Christine, is that where you help us with that?
I can do that, but it'd be nice if you had a nice sign off.
I need to come back with something like that. But this concludes the October presentation of the Northwest Suburbs Organizing for Action Fiscal and Economics Group. Thank you very much for your participation. And please feel free to share these slides widely with your friends through email and through social media and other ways. And if you ever need more information about the economy or have questions, by all means, reach out to Carl or me, and we'd be thrilled to help you. Thank you.